if you're going to retire before you turn age 62, then you'll have a gap before you can start drawing Social Security. So the government created this bridge for that gap called the Special Retirement Supplement. It's not Social Security, doesn't affect your Social Security. It is subject to the earnings test. If you want to learn more about the earnings test, go to our website or find the video on YouTube. And subscribe to our YouTube channel, please. I would love for you to do that because we're putting stuff out every week and you need to do that. And some of this subject matter was recently just put out there. There's no COLAs on the Special Retirement Supplement, and you can't do this if you retire under the MRA plus 10. So in brief, this SRS is your Social Security benefit at age 62 times the number of years of service divided by 40. Now, again, this is not a Social Security benefit. They just use the number at age 62 to make this work. Times the number of years of service divided by 40. Okay, so I'm not going to try to calculate that for you today because we've done a great job. In fact, our most watched YouTube video is around this subject matter. There's a couple of them out there that have lots of views, and I think they do the job well. So I'm going to go ahead and make sure we deliver on the promise that we had when you signed up for this online training. How do we calculate your annuity, in this case, after survivor benefits? So we've got our pension that I shared with you earlier, $30,000, let's assume. And then you've got your maximum survivor annuity option for the FERS employee is 50%. So that comes at a cost of $3,000 a year, right? So now your annuity after your survivor benefit is the $27,000 marker. Okay, so we've already lost some money because of that on an annual basis. Now let's calculate your total gross income. So we're going to start with the $27,000, your annuity minus the survivor's benefit. Then we're going to add, in this case, we're going to assume you retired before age 62. So you picked up the Special Retirement Supplement. You could also think of this as, it's a low number, but a Social Security number maybe if you're at 62. So you're going to get your pension, and you FERS folks are also going to get either a Special Retirement Supplement or a Social Security check. So we just consider these numbers to work in either case. So then you have a gross income about $42,000 in this example. Again, my accounting professor said there's nothing gross about income. So that's a great place to start your retirement planning, is to get this total calculation of what your pension and SRS or Social Security will be. From there, once we have our gross income, all we've subtracted so far, right, is the survivor's benefit. So now we need to get to a bring home income. And we're going to take that gross income of $42,000. We're going to have to make some kind of tax assumption. Now, this is where it gets real hard to do this in this kind of scenario where we're not one-on-one, but we're in a group setting. I picked 12%. That's not your tax rate. I'll tell you right up front. The tax brackets in America have, they got the 10, the 12, the 22, the 24. There's all these different federal brackets. Oh, but wait, there's more. Depending on what state you're in, which most states are represented on this call at this point, you may pay more in tax because of the state tax cost. Know your state, because there are some unique things that happen in certain states. Obviously, we know states like Florida, Texas, some other states that have no income tax. There are some states like, take Georgia, where I'm from, if you can tell from my accent. In the state of Georgia, once you're age 62, then a certain dollar amount of your federal pension or your retirement funds are not taxable in Georgia. So everyone else is paying 6%, but you. Now that's the place you want to retire. So know your state, add that in if appropriate. But so we take your gross income, we subtract some rate of tax. And again, you've got spousal income a lot of times, you've got your deductions. Can't do a tax return here, obviously on the screen. Here we are celebrating tax day. Don't you wish we could? I think we've all had enough of that as we talk through what we're doing. But you want to estimate your effective tax rate, and then you want to also subtract your federal employee health benefits, right? Your gross pay minus your taxes and insurance. That's what we all have to pay. You will need to look at your pay stub. We'll teach you some math. You ready? Look at your pay stub, multiply your health insurance cost by 26 and divide it by 12, and you'll get a monthly figure, right? In this case, we just multiplied an average 2-week health insurance by 26 to get the annual fee, annual cost of health insurance. Now, note that I have also, in this example on purpose, I put the health insurance below the tax calc. Why? Because once you retire, you do have to pay taxes before your health insurance costs come out. Right now, you are enjoying the cafeteria plan model where you don't have to pay tax on your health insurance premiums. They are deducted before tax calculations. That flips in retirement. You do have to pay tax and then pay for your health insurance. So by the time we take out from your gross income taxes and insurance, then you're going to be left with some kind of bring home pay. In this case, we just came up with what, $33,000 a year of actual bring home pay by the time we subtracted these elements. Notice we also didn't subtract other things. Oftentimes people keep dental or vision, other benefits in place, maybe long-term care. That's beyond what I'm trying to show you as a simple example here, but you have to account for everything that's happening in your deductions to get to a real bring home pay in retirement. So we've got what, $2,700 a month that's going to come in for the rest of your life or for the foreseeable future in your pension income in your bank account. So we take that $2,700 a month and we compared it to, again, I'm going to pick a number, let's say $4,100 a month is what you're actually bringing home in working. So today you're bringing home $4,100 a month. In retirement, you're going to bring home $2,700 a month. Then you've got a $1,300 a month gap. All right. So how do we get to bring home per month? If you have your pay stub, you need to do this so you can start thinking monthly. I know all your whole career you've been thinking bi-weekly, but here it comes monthly. Take that bi-weekly bring home pay, multiply it by 26, divide it by 12, and you're going to get that monthly figure, okay? So you want your bring home pay in retirement, that's monthly. You want your bring home pay today in monthly terms, and you want to get that difference. And if that number is negative, like I showed on the screen, that $1,300, there's only so many choices that you have now, right? You either work longer, and I get the question all the time, should I work another year? Should I work another year? And I tell people, well, as long as you work more, you will make more money. It may be marginal, but you'll make more money. So keep working. Or figure out how to do one of two things. Reduce your expenses or have enough assets to draw from to cover the gap, right? If you've got a $1,300 a month gap, do you have enough in your TSP to make the withdrawals work to cover that gap? So that, again, that's another discussion. We've already spoken a lot of that over the years. There's a lot of that material available on our website and YouTube. But in this case, I want you to figure out what is your gap. You cannot retire without knowing the gap between current bring home pay, what you're going to bring home in retirement, and what are you going to do about that gap. Will the house be paid off? The children be paid off? Well, I mean, the children off the payroll. Let's look at it that way. What will come of that's your life situation to reduce those expenses. And remember this, I have a lot of people tell me, well, I'll just quit doing, going out to eat and doing my nails and I won't be driving, going to work anymore. I'm like, wait a minute, aren't you going to go on some trips? Don't you want to do some things in retirement? And you don't like your nails anymore because you quit working? And when we actually talk about reducing your expenses in retirement, most people really don't want to do that. And 10 years in, seeing a lot of successful federal employees retire and enjoying the good life of retirement, their standard of living typically doesn't drop very much. Who you are today is not far from who you're going to be after you retire. And in some cases, they actually spend more in retirement. So if you have a gap, you have to do two things. If you are going to reduce your expenses, then you cannot wait until you retire to reduce the expenses. You need to try that now. Go ahead and just live on the retirement budget, see how it works out for you. And one of two things will happen. I've had it happen both ways. Sometimes people come back and say, you know, this isn't so bad. I like it. I'm retiring. And other people go, oh, I need to keep working because I don't like this. And if you will try out living on the retirement budget based on the numbers that apply to you, that give you a bring home pay differential, and you can stare at that number and fix it, then so be it. You can retire. The other fix, again, is to withdraw from your TSP, which is a scary moment, right? Will I have enough money to last 2-3 decades if I begin drawing at this rate of withdrawal? So Again, I don't have time to develop all those points, but that's your consideration. And do your due diligence, spend the time and energy to figure out how to make that work.